Okay, great. Well, hello everybody. What a great week it's been so far. It's an amazing Brella platform, and we're excited to be here. My name is Lisa Forrest, and I'm going to be presenting with my partner and co-director Heather Anderson today. We are from Live Oak, and we are with our sponsor finance search fund lending team. And we've got a pretty ambitious agenda for this hour, so hopefully we can fit it all in and pull it off here. Before we kind of dive in on the agenda and some housekeeping items, just wanted to thank Booth Kellogg for putting on an amazing event. Paul, Grant, Hereford, Danny, Ryan. Hopefully I didn't forget anyone. I think to a person, everyone has just discussed how great it's been this week. And normally this time on a Thursday night, if we were all in Chicago, we'd be at a happy hour in person. So for any of those of you who kind of thought ahead and have maybe a Miller time in front of you, more power to you. Maybe same time next year we can do it again in person. But for now, the virtual event's been fantastic. Trade show resources on the Brella platform. Just wanted to point out a few things. We've got today's presentation will be in the trade show booth for you. We've also got Live Oak's Business Pulse Q1 2021, where we survey business owners across the country. And some of the responses, especially Q1 of this year, are really interesting. So there's that resource there for you, so go check it out. We also have a veteran ETA testimonial and slideshow for any of the veterans in attendance. We really like to support our veterans on an ETA path, and we've got an Army veteran that went the self-funded SBA path, but he's Andy Rougeau's got some nice comments for any of our veterans that might want to check that out on our trade show resources. So Live Oak is unique in that we serve, for the search fund community, we serve 100% of the full spectrum, whether you're going SBA self-funded or you're going the traditional path with a conventional non-recourse choice. We do it both. So both answers are good for us. Both are yes. And what we're going to attempt to do here today is to show you some actual debt structures that talk about SBA, a little larger SBA, and then conventional as well. So Heather, hello, and what can you fill in for me on that? Oh, mute. Oh, you're on mute, Heather. Heather, you're on mute. Oh, Paul, it looks like it's not going to let her take off there.
Here I am. Okay. Sorry about that.
What did I miss? What else would you like to talk about there?
Yeah, I think you hit it. Live Oak is unique in how we serve the search fund community, in that we provide both SBA loans and conventional loans, and we're nationwide. And just, I think Lisa's stationed up there in Seattle, and I am stationed down here in Southern California, sunny Southern California. Sorry to say to some of you who are suffering with the cold weather. But our headquarters is in Wilmington, North Carolina, and all of our programs are nationwide. So if you're geographically agnostic, we can work with you. Doesn't matter where you find the business, as long as it's in the US. So that's all I have to add for now, Lisa.
Okay, great. Well, what we're going to do is we're going to take you through 3 sort of business cases. Actual deals that we've done. One will be an SBA. The next slide will be an SBA with the Live Oak Junior debt piece, where we can get into a little upmarket SBA transaction using some of our Live Oak Junior debt, which is a very popular choice. And then we're going to show kind of a down the fairway, middle of the fairway, conventional non-recourse transaction as well. And we would like to do maybe a little Q&A after we go through each example. Then we'll open it up for 5 minutes of Q&A off of each example, and then we can certainly save Q&A to the end as well. So here was a little bit of information about Live Oak up here while we were chit-chatting at you. And also, we are industry agnostic, as Heather mentioned, but also Live Oak's got an interesting take on it. We actually have some really great industry-focused teams at Live Oak. So we have like 25 different verticals. Here's just a little smattering up on the screen there of industries that we actually do know very well. So if you hit upon an industry agnostic industry type, great. If you hit upon something that we actually know a little something about, even better. So we always find that this is interesting to mention. And then kind of along the lines of what we'll be talking about today, we have the SBA 7A, SBA with conventional, and then just conventional non-recourse. So it's a product matrix we have up here. So I'm not sure that I'll be leaving this slide up for us during the presentation, but it'll be on the Resource Center in our trade show booth so that you can have this as a reference for down the road. Heather, how am I doing? Anything that's popping up for you that you'd like to add? Hey, Paul, I think you need to unmute her again. Okay.
Okay, sorry. Yeah, no, that's great, Lisa. Why don't you go ahead with this first case, and then I'll do the next one.
Sounds good. Okay, so for this transaction, this is an SBA transaction. It's a little bit larger, and maybe before I kind of head into a little bit larger case, for the most part, SBA transactions are little mini leverage buyouts. We're generally talking sort of 10 or 15% down, 10 or 15% seller note, and we're generally doing sort of 75 to 80% financing on our SBA senior debt. As everybody in the community knows, that one of the sticking points for going down this path for some is that anyone who owns 20% or more has to personally guarantee. So that's always going to be in these base cases we're talking about. Our Live Oak standard is a 1.5 minimum debt service coverage. So that's going to be on all of our SBA transactions. We're a cash flow lender. We're not collateral based. So we really, really focus on the cash flow coverage and the debt service coverage. And in the SBA world, this could be more of sort of an SDE or seller's discretionary earnings. Then you take out the new owner's salary, and that's sort of your adjusted cash flow. And we want that to cover our debt, P&I, principal and interest annual, plus the seller note annual principal and interest. We want that cash flow to cover our total debt at 1.5 times or better on a historic basis. There are SBA lenders out there that might, sort of advertise a 1.1 or a 1.25 debt service coverage, but it's been Heather's and my philosophy for years that if you're getting a 10-year amortization on your SBA loan and it's priced right, you should really, by and large, be able to afford at least a 1.5 debt service coverage or higher. So that's Heather's and my sensibility, and that's how we approach it at Live Oak on our SBA transactions. So so that's kind of down the fairway, that sort of 10 to 15% down, 10 to 15% seller note, 75 to 80% financing. That's kind of down the fairway for maybe a smaller SBA transaction. What we're going to talk about now is maybe how to take down some larger SBA transactions and maybe go a little bit upmarket SBA and get into some, nice transaction sizes. So the first SBA loan we're going to talk about is digital surveillance and maintenance. So think security systems and surveillance for hospitals, assisted living facilities, other facilities, doctors' offices, facilities that really need some good surveillance for the protection of the employees, the customers, et cetera. And in our COVID world, the company's obviously doing very, very well. It was doing well pre-COVID as well. But some interesting things about this transaction we liked that is allowing us to take on a nice size SBA loan, contracts, recurring revenue, serving essential non-cyclical customers. We had a Q of E on this one. Our searchers generally on our larger SBA loans will require themselves Q of Es. And we had some nice equity, and we had some nice institutional investors and a smattering of kind of friends and family on this one. And there was a lot of growth opportunity. So this one just really was a great transaction for our searcher, self-funded. So here's what our structure looks like. We did a $5 million SBA loan. We also then did a $350,000 conventional line of credit, because under SBA, as most of the community knows, you get $5 million to play with. Once you use that up, then you're out of SBA dollars. So we did a $350,000 conventional line of credit. The seller carried back a nice amount on this, and our searcher came in with a good amount of equity, so that we could really maximize the $5 million worth of SBA. We actually probably would have done more debt on this and done it into a junior debt combo that Heather's going to talk about next. But the searcher and the investors and the seller really liked this combination. So, and as you'll see that the EBITDA coverage, the debt service coverage was going into 2020, it was at 150 or better. We closed it at the end of the year, and by the time the run rate it was on, we were 2 to 1 or better on debt service coverage for 2020. And you can see the nice growth plan and the nice growth rate, and there was a nice transition plan with the seller. So having said that, Paul, are there any questions coming over, or Heather, can you see any?
Yeah, there's a good question about how we calculate debt coverage, and whether we take into account CapEx.
Yeah. Do you want to take that, Heather?
Oh, go ahead. Just go ahead.
Okay. Yeah, CapEx is absolutely figured. This was an asset light transaction, so there wasn't CapEx. This is a design install business model. But absolutely, if there are assets, if you're more manufacturing, or even on some of our like sort of HVAC or plumbing, if they're having to repair and replace equipment, CapEx is actually absolutely figured into our debt service. It's basically, in an SBA context, I'll get real basic. It's net income on the tax return, adding back whatever add backs we're all going to agree are okay. Because if you're finding a brokered deal, some of the add backs they're suggesting might not be, add backs we're all going to agree on. Net income plus agreed upon add backs minus CapEx minus the searcher CEO salary coming in. So that's our cash flow. That over my total debt, our P&I on our senior, and the principal and interest on the seller note is, how the calculation actually works. That's the math.
Yeah, and there's a question here that goes into a little bit deeper, that some lenders require different debt coverage multiples on different industries or risk profile. Would we also take long-term contracted cash flows to reduce the debt coverage covenant? So I think a good point to clarify here is that with an SBA loan, there's actually not a debt coverage covenant. There's only a debt coverage requirement going into the deal. And that's what Lisa's talking about at the 1.5. We don't actually have different debt coverage requirements for acquisition deals based on industry. It's 1.5 across the board. And I think Lisa was saying this pretty well, is that if you're, my rule of thumb that I tell searchers is, if you're paying a multiple between 3 and 4.5, if you're putting in that minimum equity of 10% and you're getting a seller note of at least 15%, as long as the seller note is amortizing over 5 years or longer, then you'll have no trouble hitting the 1.5 debt coverage. So it's really about kind of sizing the rest of the loan, accordingly. If you have to pay for greater than a 4.5 multiple, then you're going to likely need more than 10% equity. That's kind of the way the math would work. Anything else you want to add to that, Lisa?
Nope, sounds great.
Yeah, and then there's one other question here about personal guarantees. So to be clear, 10% equity is the minimum for an SBA deal, but we do have to get one personal guarantee at least, and it has to be for anyone who has greater than 20% economic benefit of the loan. So that's not just ownership, that's economic benefit, the difference being preferred equity returns. So rather than get into the weeds on that, I'll just suffice to say that we would take into consideration the preferred equity returns in that 20% threshold. So if you have preferred investors, you're probably going to need to keep their ownership at around 13%, roughly, depending on the rate of return, the preferred rate of return, in order to not trip that personal guarantee threshold.
And we actually have a preferred equity worksheet that we've put together that's a really nice guide for our searchers to use, just to double check that. And in this case, obviously, in this example, we had a nice amount of equity, and we had some of the investors that have really taken to the self-funded model that were on this deal, and then some friends and family. So our searcher actually used our preferred equity worksheet ahead of time just to make sure that the plan was kind of stay within those guardrails. So we can make that available if anyone wants to contact us directly afterwards.
And there's one more question about the personal guarantee. We get a lot of questions about personal guarantees. Yes, at least one person has to give a personal guarantee on an SBA loan, regardless of percentage ownership. So let's just say you had widely held ownership and nobody was above that 20% threshold, then the CEO, whoever the day-to-day manager is, would be the one that the bank would select as the one required to give the personal guarantee.
Great.
Oh, and one more question about personal guarantee. I see. We love that. Do you need a certain percentage of the loan value in personal assets to qualify as a guarantor? And that's a big no, you don't. So most searchers don't have personal assets or a significant personal net worth at the time that they're using an SBA loan, and that's okay. The personal guarantee isn't meant to be backed up by personal assets. That said, if you do have assets such as real estate, and you have equity in real estate, the SBA does require you to pledge a junior lien in that real estate if the equity is 20% or greater. But if you don't have it, if you don't have equity in real estate and you don't have other assets, that's perfectly okay. It doesn't matter.
And to that point, the thing is, when you're vetting your lenders on the SBA, not everyone's a cash flow lender. That's why I'd mentioned that in the preamble, and that's a real important point. There are some lenders that once you hit a certain goodwill maximum, then maybe collateral kicks in. There's lots of different ways you can approach it, but for true cash flow lenders, to Heather's point, that's we're really going on the basis of the historic debt service coverage, and then also the growth plan that you have and what you're bringing to it from a resume perspective, and not necessarily a personal financial statement or collateral standpoint.
Another question on personal guarantee: what if my spouse owns real estate? Would I have to put a junior lien on her assets? So no, not necessarily. If your spouse owns the real estate separately from you, you're not owning it jointly, and your spouse is not going to be part of the ownership of the business that you're buying, then no, your spouse would not have to. In the other scenario where you are buying the business yourself, but your spouse owns the real estate with you jointly, then your spouse would be required to pledge their interest in that real estate.
Great. Should I move on to the next slides?
Sure.
Okay. All right. Heather is up next with her example. Heather, did you want me to start with the key details, or just go to the...
Just start right there where you are. It's good. Okay. So this is a nice deal, and it's just a different example of what we can do with SBA. This is a situation where we maxed out the SBA at $5 million. And then we also provided a companion loan, what we call at Live Oak a companion loan. That's a conventional loan alongside the SBA of $2.3 million. Now, sometimes the companion loan is going to take a junior lien position in assets, and sometimes it's going to take a pari passu or an even position in assets. Either way, the SBA allows this, but what's kind of interesting about this structure is not a lot of SBA lenders provide it. And at Live Oak, we learned to provide this structure after trying, and not successfully, to get mezzanine lenders to provide junior sub debt behind an SBA loan. The reason we were unsuccessful with that is that mezz lenders tend to have a lot of requirements that they want to put into their loan, the term and other requirements and conditions that are not compatible with an SBA loan. So what we found is that we have to sort of, Live Oak has to sort of take the role of being our own mezz lender if we want to be able to do these transactions. And of course we do, and these can be really good transactions. What to keep in mind that's different when you have to max out SBA and use companion debt is that the companion debt is only a 7-year term and the SBA loan is a 10-year term. So whereas I gave the example earlier that, you could pay a 3 to 4.5 multiple, put that 10% equity in and the 15% seller note, and you should come out to the 1.5 debt coverage sort of automatically. It doesn't quite work as well that way when you do these little bit larger transactions. So in this case, you can see, it's a 9.8 million total enterprise value. So that right there tells you this was a little bit higher multiple than your typical SBA deal. So a little bit higher multiple, and the fact that the companion loan is on a 7-year amortization instead of 10 means that you need more equity to get to that 1.5. We wouldn't otherwise easily get to the 1.5 coverage that we need if they put a whole lot less equity than the 20% that they put here. And you can also see in this case, the seller didn't carry as much, but it was perfectly okay because they made up for it with equity. We had very stable cash flows. There was, some improvement that happened in 2019 and carried on into 2020. We had to get, to where we really understood that in the underwriting and could feel comfortable that it was sustainable. And then also this business, speaking of COVID, we've got businesses that are going to have COVID headwinds and COVID tailwinds, and some are COVID neutral. This was an interesting deal because it had headwinds and tailwinds. It had 2 customer segments, one that was increasing because of COVID, and one that was in the shipping space, and one that was decreasing. Fortunately, the one that was decreasing in this business was the smaller sales channel. So net, they were out actually ahead. But I wanted to touch on that because it's a little challenging to underwrite deals with COVID impacts, period. It's obviously easiest for all of us if it's COVID neutral. If it's COVID headwinds, we're probably going to, put the deal on pause until things stabilize. And if it's COVID tailwinds and COVID is actually helping them grow, and that's problematic too, of course, because no one knows whether and where, the sustainable cash flow is sort of going to land after COVID. So this one was interesting because they kind of canceled each other out, and we sort of discounted the excess headwind that they were getting, or sorry, tailwind that they were getting from the shipping side of the business. But this is a good example of something that Live Oak can do, so where you can still use the SBA program for a larger deal than you might normally think of with the SBA program. I see you might have a couple questions coming in here. Usually the AR is left to secure the line of credit, but a second, okay, so good question. So this particular deal, we didn't need to do a line of credit, so you don't see that in the example. But almost every deal that we do does require some line of credit, working capital for the deal. So a lot of thought is put into analyzing, exactly how much working capital the company is going to need going forward, and on what basis. Is it going to be needing term working capital, or is it going to be needing line of credit? And then we put the right type in place, and we always carve out the receivables and sometimes the inventory as well to be able to be available to secure the line of credit. So just getting an SBA loan doesn't mean your hands are tied and you're not going to be able to get the working capital loan that you need. We always provide both, and we carve out the collateral separately. What interest rate should you expect on the companion loan? Good question too. They're a little bit higher than the SBA. So, it's not quite as high as traditional mezz debt, but it is a couple points higher than the SBA. So when you're modeling it, you want to look at it that way. Is the 1.5 debt coverage ratio test done annually or just at the inception? So another good question. It's only at the inception in the sense that we don't have covenants. So SBA loans, one of the big advantages, in addition to the 10-year term, is the fact that we don't have covenants. We only test debt coverage going in, so you have to be at least 1.5 or better. And then, after that, we're going to collect quarterly financial statements and annual tax returns. But let's just say you fall to 1.3 or 1.45. You're not going to be in violation of anything. Main thing with an SBA loan is to provide your quarterly financial statements and make your payments. And that's kind of it. There are no covenants.
I will add, though, that we do have that sort of 150 backstop on our seller note, though. So in the in the seller subordination, we do have an addendum that says there's a 150 debt service backstop, which gives us the opportunity or option to, potentially, put a little stop on those seller note payments if, in fact, the debt services has been impacted for whatever reason. And I will tell you that our clients that we did loans for in 2019 were very appreciative of us having that backstop when it came to 2020, when they were able to go in and help us, because of the language, renegotiate some of their seller notes.
Yeah. And I think I'll touch on, even though it's not here in this example, but I'll touch on the forgivable seller note at this point, since we're talking about seller notes. The SBA does not allow sellers to roll equity or to have warrants or to have earnouts. And so a lot of questions come about, trying to structure your deal with those things, and the SBA just won't allow them. You can't get an SBA loan if you have those in your deal. But you can do a forgivable seller note with an SBA. And the difference between that and an earnout is you can tie the metrics of the forgivable seller note to some level that the company's already achieved. As long as it's not tied to a growth metric, it's okay. So, for example, say there's a key customer and you want to tie an additional seller note to retaining that customer for at least 2 years at a certain level. That's okay. If the customer's not retained, the note gets discounted and goes away. It sort of right sizes the deal for you. So that's something that you can do with an SBA loan, but you cannot have an earnout per se.
Yeah, we utilize those clawbacks a lot. You can also use escrows in SBA transaction as well. Escrow holdbacks.
Escrow holdbacks are used as well. And I see a question, owner cannot stay in the business post 1 year, and that's correct. So that's another rule. The SBA is looking to see that the founders are completely exiting the business from an equity position right away and from an operating position within 12 months. So that is correct. You can't have rolling equity. You can't have a seller that wants to stay in some kind of a operating role in the business. They have to exit within 12 months. And a question about the companion loan and the collateral. So are the SBA loan and the collateral loan secured by the same assets? Yes. As I mentioned earlier, we can either do a senior junior type structure so that the companion loan is in the junior position, or we can do what we call a pari passu, where they're essentially sharing pro rata in the business assets. But either way, as Lisa pointed out, Live Oak is a cash flow lender. So when we talk about collateral, we really don't have collateral coverage in these deals at all. These are usually asset light. We're not really going to be secured in that kind of traditional sense by hard assets. So hopefully that answers that question.
It's a really popular program. We're talking with a lot of searchers that are enjoying the ability to cover that gap with our conventional. So it's been really fun for us.
Yeah, and I don't know if Lisa, if you want to turn the page here, I don't remember what's on the next page, but just a little more details about this particular deal if anyone's interested. It was a very diversified customer base. They had sales channels in photography, music, and warehousing. As I mentioned, the warehousing was growing. The photography and music was facing some COVID headwinds. It was a recurring revenue base, which is great, just the kind of thing I know you're all looking for. And they had, very high quality product at a moderate price, pretty diversified product portfolio, had made a lot of improvements to their operating margin in 2019 that they were able to sustain, but there was still a lot of low hanging fruit and room for improvement that attracted the buyers to this particular deal. and a great management team, which incidentally, is really important in our underwriting with searchers is you, the CEO, and how you fit into that company's, future plans. But also your board of directors, we really think that's an important part of the underwriting. Who's going to be your chairman? What sort of oversight and what kind of experience your board has. And in this case, it was all excellent. So we love this deal, and we were happy to provide both SBA and companion debt with this one.
Great. Should I move on?
Yeah, I see one more question before we start the next deal. How do you address industries that require a multi-year transition of a license like HVAC and plumbing? So that's a good question. And that is one where, going back to one of the earlier slides that listed all our verticals, we actually have an HVAC a service contractor vertical. So we have a team that specializes in that industry. Usually there has to be a laid out plan of how either you're going to get the license within the 12 months, if it's going to be held by the seller for the first 12 months, or an existing employee. Sometimes the employee can be the license holder of record for that period, but you definitely have to have a plan where we understand, that there's not going to be a period or a gap or anything longer than 12 months that we're going to have to rely on the seller's license.
And that's where you can utilize that clawback on a seller note. You can tie a seller note stipulation that if for some reason the license doesn't transfer in the way that you've agreed upon, maybe there's a clawback on that seller note. In some jurisdictions, states, you can also hire a third-party administrator to be your administrator of record, and you actually pay a third party to do that. So this would be an area where you would want to talk with your lender, talk with us way up front if you've got this industry that you're interested in, and it's sometimes it's deal by deal.
A cannabis question. Has there been any movement by the SBA to fund cannabis related businesses? Now, unfortunately, it is highly restricted. Anything and everything directly and indirectly to do with cannabis is not allowed in the SBA program.
And I live in Seattle, so there's a lot of that really good cash flow business where I live personally, but yeah, there's, can't do that federally yet.
Okay, Lisa, do you want to go to the next slide?
Okay. So now on to conventional lending. And in this sense, and we also have conventional with personal guarantee too. So we have a whole nother bucket that we just didn't want to get into. That was just going to get too crazy on these slides today. So for the other, the traditionally funded searchers that are looking for conventional non-recourse debt, we have that as well. So the one example we wanted to talk about was just really kind of a down the fairway kind of structure. It is in internet service provider is the industry on this one in a rural area. We also have a broadband and an internet service provider vertical. So on this particular transaction, we were able to give a lot of really nice feedback and some extra vetting from our general manager vertical on this transaction. And it was in a rural area. We had two partner searchers moving from sort of a real big city, moving to a smaller city. And their idea is to then grow geographically as they kind of get their feet underneath them. And then the plan was to grow geographically around that rural geography. Low customer concentrations. The partner CEOs complemented each other very, very well. Most customers were on a 3-year auto renew contract, so very recurring, very low churn, 95% customer retention. There was a really nice customer survey was done during the due diligence on this one, and just the customer ratings were just really stellar. Business had been around for 25 years. The average customer, I think, was 10 years. We had seller rolling equity on this one, which, compare and contrast with the SBA world, you can't do that, which we as lenders love. We love the idea of seller roll. I wish we could do it under SBA. So it's a strategy that's used quite often in our conventional structures where the seller's going to roll that equity, which is great because that allows for continuity. And especially when the seller's got a skill set that you want to reward for them to help with that transition and then to also help with the growth too. If now mind you, obviously the new CEOs coming in, they're in control and they're in charge, but in those cases where the seller wants to stay on and help grow and have a sort of a bite of that, we really like the seller role part of it. And in this case, I'll show you that we had a 2.5 turns of EBITDA on the structure. It's a really stable business. The staff was already professionalized. The sellers had done a really nice job of prepping the company for exit. And the seller was actually really largely absentee. And they just really wanted to come in and kind of help continue to grow it. They were really good on that sort of sales front. They had recently expanded all the infrastructure. So the debt structure was based around the fact that it was already professionalized and we didn't have to, the CEOs didn't have to clean up a lot in the infrastructure, which I'll comment on the structure here, because when you're having to come in and maybe professionalize, you might want to structure the debt a little differently. So kind of with that backdrop, I'll show you how we structured this one. So we did a $5 million conventional non-recourse. We then also did a $600,000 conventional line of credit. The seller rolled $2 million, and then we had an equity check on this one of $6 million. So this is a really nice structure for us. We actually probably would have provided some more debt because we'll go up to 50% debt, senior debt on the cap stack if we're the only debt in the transaction. And in this case, it was all seller roll. But because of the run rate and the growth plans, this is what the CEOs and the investors really decided was just going to be a really nice fit, was going to really allow them to get in a transition. And, we closed this loan March, I think it was March 2nd. So, given everything that transpired in 2020, this was probably a really, really nice debt structure, which gave everyone breathing room, and especially with that global pandemic that we weren't planning on really. So some of the things that we talk about when we're trying to decide how much debt, we're going to also talk about the investment thesis. So what are the CEOs and the investors? What is the plan for the company? Is there going to be a J curve with EBITDA? Is EBITDA really, is it maybe going down because you've got to professionalize or you want to make some investments in the infrastructure or sales channels, what have you? In this case, that was already done. So we didn't really have to spend too much time worrying about what the EBITDA, if EBITDA was going to go down. If anything, we were just assuming it was going to be, tracking similar or going up. But those are some of the conversations we have when we're trying to decide how much debt on a conventional transaction. So generally, turns of EBITDA for us, kind of 2 3/4 to 3 turns of EBITDA on senior debt, and then 4 turns of EBITDA max on total debt. Those are the when you've got like a seller note involved. Those are the 2 initial data points we like to track. We also like to track 40 to 50% maximum senior debt on the cap stack. That's another data point we track. And then also we're generally kind of looking to be around a 1.5 debt service coverage going into it on TTM. That's also just sort of a gatekeeper we like, just to make sure that historically we've got enough room to fit the debt in that everyone is discussing. So we talk a lot about transition. We do this on SBA too. We talk about transition plan, but we absolutely talk about it in our conventional transactions, especially when you've got maybe a high growth type of industry. We want to really make sure we're understanding it so that we're fitting the covenants properly based on where the company is going to head. And so on this one, we had some nice debt service coverage going into it, 2 times or better, obviously on a Q of E transaction. We have financial and non-financial covenants. So I mentioned some of the financials covenants. We might also have a liquidity or a current ratio covenant. It really depends on the transaction and the industry if those are going to be appropriate. And then we have some non-financial covenants around how often you need to give us financials. Is it an asset-based lending line of credit? So are we going to have maybe monthly balance sheets you need to give us? That's going to be all sort of deal to deal specific. Some things that we will see on our conventional structures, we might see earnouts. Can't do those under SBA. We might see those earnouts in our conventional structures. And I think the trend at the latter part of 2020 is that we were seeing more earnouts. And I think that sort of everyone in the ecosystem on the conventional side would agree that we were seeing more earnouts than ever. And it'll be interesting to see if that plays out to be a trend that continues, or if that was just sort of a COVID-related byproduct of concerns or whatever we were trying to mitigate, and just the price that the searcher CEO was able to lock in with so much turmoil going on. But we'll see how the earnouts go. I think earnouts can be fairly problematic sometimes, but I know that might be the solution to get the price that you need to get the transaction to the table. I think it was Ramjani's panel yesterday where the actual CEOs talked about the earnouts that they were trying to live through and trying to actually execute now that they're in the CEO chair. And those can be dicey, but they're allowed, and we really want to make sure we're understanding the metrics around the earnout, so that if you're having to pay earnout Y based off of your projection, does it make sense? We try to help you right size that by backing into covenants if you're having to pay earnouts on your estimated metrics. So we try to help you reverse engineer that right in the beginning, while we're kind of helping you analyze deals.
So Lisa, there's a good question about covenants and sizing covenant flexibility. Do we provide a cushion for their growth plan? How does that work?
Yeah, so that's what I was talking about with sort of that J curve, and we absolutely want to know what your growth plan is and your thesis. Absolutely. We spend a lot of time talking about that to make sure that the covenants that we're going to put on are appropriate, adequate. We want to make sure that you're getting the room. For the most part, most of our conventional deals are structured with, 6 months to a year of interest only. And then quite often we'll have some sort of covenant holiday for maybe 6 months to a year while you are transitioning, and giving you that room to get your feet under you, and then have the company be your own before we start kind of hitting you with that covenant. It's not that we're not going to be measuring them as you go, but for the most part, we do provide a covenant holiday in for a period of time.
And then there's a question about, back to the companion loan, pricing being about 200 basis points higher than the SBA. They're asking what the interest rates are on the conventional loans.
Yeah, so conventional works differently than our SBA. So SBA is a variable rate program because we are doing highly leveraged transactions with really, in a lot of cases, like sort of the maximum amount of debt you could do, in our 150 service cushion that we want. But it's a much different program. SBA is variable. With our conventional deals, these are fixed rates. And it's usually a 7-year AM, 7-year term. Forgot to mention that, because we are providing, 30 to 50% of the cap stack. These are going to be fixed rate pricings.
So there's another question about what is the typical level that the financial covenants are set at?
Level. So generally we will have 3 turns, and I want to make sure I might not be answering the question. So if I answer and whoever's asking it, if I didn't hit it, keep going. But generally we're going to have 3 times, 3 turns EBITDA max on senior and 4 turn max on total debt. And then we have a fixed charge coverage Generally, that's going to be about kind of 120, 125 on a fixed charge coverage, FCCR. We don't have a cash flow or capture generally. We don't have prepayment penalties, but it's generally the EBITDA turn and the FCCR are going to be kind of the two biggies.
Okay, and there's another question. How involved are you for CEOs whose business may be struggling or on the verge of triggering a covenant after close?
Very involved is the answer. And we spend, Heather and I spend so much time on sort of even we'll back up the pre-LOI process of, working with you before you even have an LOI inked. So we pride ourselves on spending a lot of time with our searchers, soon to be CEOs, getting to know you. And generally, I think people will pick Live Oak because we really appreciate the conversation. And we want you to be talking with us, even pre-LOI, LOI, and then the whole closing process. We're very involved. We have, our two servicing folks that are dedicated to just our search fund space. So your servicing folks, they're called business advisors, actually, while you're in servicing, it's our one search fund team. So the long answer to that, that's the long answer. The short answer is we're very involved. And anytime you have a lending relationship, if you're seeing anything that's inkling, this is getting dicey or awkward or uncomfortable, you want to talk with your lender as soon as possible.
Yeah, and I would add a little color there. We had clients in our portfolio at the beginning of the COVID shutdowns that were very concerned they were going to trip some covenants, and they handled it well, and I think we handled it well. And just like Lisa said, having conversations early and often before it even happened, and frankly, most of them, everything turned out just fine. It wasn't as bad as they were expecting. Like Lisa said, we're very involved. We don't just close a loan and walk away. We stay very involved, and we have meaningful discussions about where they're going, whether they need room in their covenants, whether they need to make a distribution, that kind of thing. And generally it works very smoothly. I see another question. How did PPP processing go for your clients? Did a lot of your clients use the program? Yeah, so PPP round one, most of our clients did access it. And the way Live Oak handled things is that we prioritize, like a lot of banks did, our existing customers over new PPP borrowers. So they all got served first. They got served very quickly. And then, there's a small portion of our existing customers that are now coming back for PPP round two at this point. I did want to touch on, there's some SBA stimulus out there for new SBA deals that did just change slightly yesterday. So you may have heard that if you fund a new SBA loan right now, that you would get 6 months of payments up to $9,000 a month paid by the government. As of yesterday, they shortened that 6 months down to 3. So it's now only 3 months up to $9,000 per month. So $27,000 worth. It's still not nothing, but it did just change.
One thing I wanted to comment on, and then Heather, you can kind of queue up some more questions, but for our conventional transactions and our conventional relationship, we also will talk with you about your annual budget. You need to send kind of annual projections in. So we're going to talk with you at minimum a couple times a year, and especially around your annual projections. We're seeing trends with our CEOs that are now more seasoned, where now they want to grow by acquisition. So we want to stay in close contact with you. So as you're ready to kind of take that next debt step, if it's growth by acquisition, maybe you want to refinance your seller debt. Maybe we're getting at the end of the seller debt kind of pick term, and you want us to help refinance that, or maybe you're getting to the point years later where we might recap some investors. So that was a kind of an add-on to how much communication and contact do we have with our portfolio, and it's a lot, because we're hoping to be in your life and you in ours for quite some time.
Yeah, and here's another question. Do we offer delayed draw term debt? So great question for acquisitions. Yeah, as a matter of fact, I have a proposal out on one now that I was just thinking of. So yes, we definitely have clients from the search community that come to us with really sound roll-up strategies. And rather than, fund them one at a time, they prefer the more organized approach of a delayed draw term loan, and we definitely can provide those, and we love to provide those.
Great. Paul, how are we doing on time?
We have probably about 10 minutes left.
Great.
Lisa, maybe go back to that slide that compares the SBA program with the conventional, and just, yeah, that's a good one right there. So I think what I'll touch on here is that almost without exception, self-funded searchers use the SBA program. The reasons for that are they're generally looking for a little bit smaller companies that are going to fit within that 5 million or the 7.5 million that we can do with the SBA plus companion. And also they're going, frankly, to own enough of the equity ownership of the company to make giving that personal guarantee worthwhile. And as long as you can get comfortable with the personal guarantee, frankly, all the rest of the terms of the SBA loan are better than conventional. It's a longer repayment term. There's no covenants. There's no prepayment penalties. So really the drawback is the personal guarantee. But if you own enough of the company, most self-funded searchers get comfortable with the SBA program. And then on the other side, anyone that's thinking of going or is going the traditional search fund route, they're going to end up using the conventional programs. That's a function of, just the amount of equity that their investors are going to want to put in. The size of the companies that they're generally going to be looking at are larger. And so it just makes more sense. We rarely see anybody cross, we don't see a self-funded searcher use a conventional loan, and the other way around. We don't see a traditionally funded searcher use the SBA program. So really, we've got programs for both, which is really nice. What percentage of our lending to searchers these days is SBA versus SBA plus conventional versus conventional? Good question. So right now, SBA is about 50% of our business, and conventional is 50%. Within the SBA side, I would say maybe 20% of that is with the companion loan. So the larger SBA deals, that's pretty popular, but we're running about 50-50.
And I would say that that's the sort of conventional junior, and you can hear my dogs barking in the background. That's me. The conventional junior with our SBA, that's trending. Maybe it's 20%. That's definitely trending upward. We're seeing larger deal sizes also for conventional as well. That's kind of two trends that we're definitely seeing.
And yes, we are going to post, or this presentation is posted in our booth. So if there's any of this presentation that you want to be able to access, you will have access to it. I see a question. Hold on, it just came down the screen about personal guarantee, what it covers. So a personal guarantee with an SBA loan is a full guarantee. It's not limited. So you are guaranteeing the full SBA loan. And if there's a companion loan, you'll be guaranteeing that as well. There's no liquidity requirement for the personal guarantor. As I mentioned before, there's no asset requirement. So you could have nothing theoretically and still, be required to provide a personal guarantee. The only other way to look at it is if you do have assets, if you have real estate with equity that you own yourself or with a spouse, as long as it has 20% or greater equity, you would have to pledge that. But if you do not own real estate or it does not have equity, you don't have to pledge anything with your personal guarantee. So hopefully that covers that question. I see one more here.
I was going to make one comment on our grid here for conventional, where it talks about minimum EBITDA. And we do have 1.3 million here for minimum EBITDA. Because we will go a little bit down market on our conventional non-recourse. However, the comment there is that for smaller EBITDAs, we're going to actually want a lesser turn of debt generally. So generally on our conventional kind of that 2 3/4 turn and above, we're looking kind of like $1,750,000 or 2 million and above for that EBITDA. But we were also seeing some really nice transactions that were smaller and still had really nice sponsor investor support and had great growth stories. So we kind of opened up our bucket of minimum EBITDA size for conventional non-recourse, but then we're gonna look at how much senior debt we're gonna provide on something like that. So I just wanted to make that clarification.
We have a great question on when a self-funded searcher, and for that matter, this applies to traditionally funded searchers as well, when they should engage the lender in their process. So our recommendation and kind of best practice is to reach out, make sure first of all that you're talking to a cash flow lender. As Lisa said, there are a lot of SBA lenders in particular who are really more interested in whether you're buying real estate and how much equipment or other assets the business has. So that's not going to work for most of the deals you're going to be looking at. So you want to first find the lenders that understand the search fund community and the model itself, and are a cash flow lender and that are going to make credit decisions not based on collateral. And have that introductory call at the beginning of your search so you get to know each other. The way we work with searchers after that is we invite you to pre-screen some deals with us before you submit your LOI. So you provide us with 3 years of business tax returns. We have a quick little questionnaire and what the terms of your LOI are going to be. And we will quickly turn that around in our model and show you, maybe whether or not we'll determine whether or not your LOI is SBA compliant, because we can help you with that. And we'll just ask some questions and provide some feedback so you know whether what you're proposing is easily financeable. We'll usually do that 3 or 4 times before you get a deal where the LOI is accepted. And that's a great process for us to get to know you and how you look at deals, and for you to get to know us and what our bank lens looks like on your deal. And so that's helpful. By the time you get a deal under LOI, we're already working well together and we can kind of get to the close more smoothly that way.
Yeah, we like to make sure that help you in any way we can to make sure that the LOI you do get inked is in best possible position to actually close. And if you do email us, direct email or direct message us, we actually have some, due diligence questionnaires and a little bit of a sort of workbook and work pages that we think might be helpful tools for you on a pre-LOI basis. So you can do a lot of that work yourself and vet a lot yourself.
What fees are involved for the closing? It varies whether it's SBA or conventional. I should note also that under the current stimulus package, the SBA guarantee fee, the main loan fee, is waived until September 30th or the money runs out. So right now you actually don't have to pay fees on SBA loans, and you get 3 months of payments made for you. So it's pretty nice. But in general, for a conventional loan, you're going to be paying a 1 point origination fee. You're also going to be paying a point on your line of credit. And then normally for an SBA, there's a sliding scale for the SBA guarantee fee, but that is currently waived.
And for some of these larger transactions, that SBA guarantee fee can be about $150,000. So that is a boost to working capital, because we'll still give you the max loan, but transition that to working capital instead.
Yeah. Okay, we're right at time. I don't see any more questions either. So does anyone else, if you have a question, please go ahead and post it in the chat. We're happy to stay a little bit longer if you have something in specific you want us to talk about.
And also give us feedback. How did you like looking at the slides? And we didn't want to bombard with too much information, but we were hoping it was going to be just enough bite-sized information to share with you.
It looks like people are saying thank you, and they're going to happy hour now.
Okay, well, and again, thank you so much to Booth Kellogg. Thank you to all the organizers. Thank you, Paul, for hosting us on these events. And it's been a great week. And now we look forward to all the panels tomorrow.
Perfect. Going to be a busy day tomorrow, and this was excellent. I don't think there are any more questions because I think you may have covered all of them, but so much great information here. Thank you guys so much for the time. Everyone who's watched this presentation, make sure to visit the Live Oak sponsor booth on Umbrella, as they have a lot of this collateral information there, and we'll be posting this actual presentation there tomorrow as well. But well done, guys. Thank you so much.
Thank
Good
you,
night.
Paul.
Good night, everyone. See you tomorrow.
Yes.